Great. Let's get a quick comment from Equitas Small Finance Bank. It's the first corporate on our radar. I do want your thoughts, Devin, on this. The bank reported a robust loan growth in Q3, while profits were also above street estimates. Asset quality has improved sequentially, while there was a strong growth in the MFI and the commercial vehicle portfolio. T.N. Vasudevan, who's the Managing Director and Chief Executive Officer at Equitas Small Finance Bank, joins us now. Mr. Vasudevan, good morning. Before I get into the nitty-gritties of the numbers, you cater to a lot of the pockets in rural India, small businesses, MSMEs, NBFCs, etc. Do you see some stress? Because we understand that consumption patterns are, weakening a bit because of how inflation is hitting pockets. Can you tell us whether the growth rates that you've seen up until now, is that something that you can maintain, or does it look difficult given how the challenges are playing out?
Yeah, good morning. I have been on your channel earlier, and we have been kind of informing all of you that the business model of Equitas is slightly different from that of the regular, the larger banks. Our lending is 90% to the informal economy borrowers. And when I say informal economy, basically we are talking of people who are into daily use product and service, sales or service. Like a kirana shop or a restaurant or a two-wheeler mechanic shop or something like that. So generally, there are two elements to this segment, which is that one is that there is a large unmet demand from the informal economy because they have not really been serviced by the banks in all these years. So there is a large unmet demand for loans. And second thing is that they are generally very resilient, except in extreme situations like the lockdown that we had last 2 years. If the city is locked down, they can't do much. But so long as life is normal, their revenue always comes in whatever happens from an inflation or a GDP perspective, because they are selling things which people need on a daily basis. So generally we see that our customers are very resilient, and our pre-COVID GNPA always used to be in the range of 2.5 to 2.75%.
And that, Mr. Vasudevan, hi, good morning. No, I think that question perhaps it also comes because we've been talking about a K-shaped recovery, right? I mean, the lower end is not doing as well, pickup being very slow, and perhaps a little more of slowing rather than acceleration. So but you've said that things are, pretty okay from what I understand in terms of what you said. So what does that mean? What will loan growth, etc., look like? Can you maintain what you've done in the third quarter? You mentioned GNPA is at a certain level pre-COVID. What will that be in your assessment going forward?
Yeah, good morning. As I mentioned, the demand from the informal economy borrowers continues to remain quite strong, fundamentally because there is a lot of unmet demand in the system also, which is something that we have to be very cognizant of. For example, in our last quarter investor presentation, we have set out some statistics from the government, which says that the unmet demand from the small business borrowers is something in the range of 20 lakh crores, unmet demand itself. So there's really no dearth of demand. The question only is how do you lend to them and how do you efficiently collect it back from them. And that's where Equitas has been very strong over the last maybe 10-15 years. So given that scenario, and given the fact that generally, GDP is expected to be reasonable even in the coming year, we believe that a 25% plus growth is something that we should be able to maintain over the medium term.
Right, and you've mentioned that in the past as well, Mr. Vasudevan, that 25% and maybe on that base for the next year, I think you were guiding close to around 30% as well in terms of loan growth. So we got those numbers. Now the problem is on the NIMs. Cost of borrowing has been going up, but you're going to be growing at a faster clip. What's your sense in terms of NIMs, if you could guide us out there? And also you were mentioning about the asset quality. Your gross NPAs, I think as of last record, are around 3.6% and net NPAs around 1.82%. Give us a number on this as well. So NIMs and asset quality. Go ahead.
Yeah. So on the NIMs, currently our NIM is around 9%. It's been kind of holding up in the last 2-3 quarters. But internally we look at PPOP, that is the pre-provision operating profit more closely than the NIM, because we are still a very small and an evolving bank. We are not a completely mature bank, so there's still some amount of changes that's happening in our product mix on the loan side. 2 years back, our average ticket size used to be 4 lakh rupees. Today, our average ticket size is around 6 lakh rupees. So that improves in terms of some amount of efficiency in the system. And part of that does get passed on to the borrowers. And so our NIM might come down over a period of time. But the operating cost also should proportionally come down, enabling us to hold the PPOP level at around the 3.5. So our real aim internally in the bank is how do we maintain a PPOP, that's the pre-provision operating profit, around the 3.5%, which should lead to a healthy 2% plus ROA. So that's more the focus rather than the NIM per se, because as I said, we are still an evolving bank. As far as the GNPA is concerned, if you include the IBPC assets also, our GNPA last quarter was around 3.45%, and equivalent to that pre-COVID used to be around the 2.5 to 2.75. It had gone all the way to 4.6 at some point in time during the peak of COVID, and it's been coming down. And we believe that in the next maybe 2-3 quarters, we should get back to our pre-COVID levels of 2.5 to 2.5.
Okay, all right. We leave it at that. Thanks a lot for joining in. That is Equitas Small Finance Bank saying that the demand for the informal economy that they cater to, the borrowers, continues to be very strong. Deven, any thoughts on this talk and the commentary that the management has made?
So I think the real challenge hereafter would be how do they manage the liability side? Because on one side, the cost of funds has started increasing, and it is unlikely to settle down at lower levels as it is in the near future. Given that scenario, I think most of the banks would be probably challenged to keep the cost lower as far as I think the funds are concerned. So I think they would have better ability to manage the cost as far as operations are concerned, but I think the cost of funds would remain on a higher side. That could possibly put the pressure on NIM. I think particularly for Equitas, I think somewhere in 2018, I think the NIM was somewhere below 7. Today, I think this is somewhere in 7.25, 7.5 range. I guess I think this particular situation would probably play out. They should be from April to June quarter onwards. I'm expecting, I think, a larger pressure on NIM coming for them. They are growing at a reasonably high growth rate. That is a good sign. But I think the cost of funds probably would be the issue which could affect the margin. But overall, I would think that I think the margins, rather I think the valuation-wise also, this particular bank is reasonably quoted at a lower levels now compared to what it used to in past. So from that perspective, the downside remains limited, and the upside I think would depend largely on the factor of NIM as I said.
In the defense space, the order wins continue to come through.